First of all, I'm going to start recording just for posterity in case we say anything important here.
Make sure I look okay.
Not a problem.
Okay.
Just let me get through quickly some of the administrative items that I had. Of course, that first discussion forum is scheduled to close tomorrow. I made a couple more posts today
Yeah, I saw him.
that I was hoping people would be able to see. And of course, I think on the first case, the Bethesda mining case, you had indicated you had your phase one ready to come in, except there were some blanks
Yeah, yellow blanks.
in years 5 and 6. Is that correct?
And 0.
And 0. Yeah. Right. That's correct. I mean, there should be some entries in years 5 and 6.
Oh, okay.
There should be some entries there. In year 5, you've got, for example, you've got land restoration costs.
Okay.
Even though they're not producing anymore, they've got, I forget the exact amount, but land restoration costs, which will result in a negative net income for that year, and a tax credit for that year. Then when it comes to the 6th year, there's actually the charitable donation of the land creates a tax credit that also affects is a cash flow item. It's a tax shield cash flow that's associated with the deduction they get to take for making the contribution of that land.
Okay. That's the reclamation.
That's year 5. Right?
Okay.
That goes in as an expense. There's no revenue, so it's going to just fall right to negative net income, which will give you a negative tax consequence. In a case like this, the assumption is that the company has other income that they can use that loss associated with the reclamation costs, that they can use those losses to shelter other income that they have from taxes. And so that's why you acknowledge or you recognize that as a cash flow.
Okay, I didn't have that in, possibly thinking that it was supposed to go in elsewhere, like in the next.
No, it's going.
Froze.
What's that?
I thought you froze.
No, I just stop moving for once. No, so just put in the reclamation cost as a fixed cost in year 5, and then put in it's fixed because it doesn't vary with volume. They're not producing anything.
Right.
And then in year 7, just put in the tax shield credit for the charitable donation, which is about $6 million or whatever the number was. The value of that contribution they were making. So the tax shield will be the tax rate times the amount of that deduction they're taking in year 6.
Wait, say that again.
What is the size of the? I don't know if you have it there. The size of the deduction they're going to be able to take for donating the land.
The expense deduction will be $6 million.
Yeah. So that times their tax rate tells you the size of the tax shield credit that they will earn as part of that charitable deduction. That's the only cash. Obviously, they're not going to be paid for the land. It's a donation, but they do get this tax credit that's equal to the tax rate times the value of the land they're donating.
Oh, okay.
And just put that in as a negative tax in year 6.
Okay.
And that, along with the land reclamation costs in year 5, means that those last 2 years you in essence have negative, you have negative net income, but you actually have you have negative cash flow in year 5 and positive cash flow in year 6.
Okay.
So just go ahead and
That's funny. This having, you doing the spreadsheet was great, and then I was playing around with the formulas,
yeah.
sort of figured them out. So when you say show math logic, do you mean just in the cells?
In the cells, put, if you're adding something up, put,
C1 plus C2.
right, exactly. Rather than just pasting numbers in, because I wanted to be able to diagnose.
That was the easiest thing to do. I figured out how to do it, but then it was nice, or it is nice, because anytime a number changes,
Yeah,
everything's automatically adjusted.
right. So yeah, that's all. I just wanted to see the mathematical logic in each cell
Okay.
where appropriate. Now, some of the cells obviously you're just filling in given data,
Yeah.
in the input stuff, but in the calculation, the P&L and the operating cash flow itself, I'd like to see that.
Okay.
All right. So we'll just complete that and fire it off to me, and then I'll check it out and get it back to you tomorrow. And then you can move along to the phase 2 part that's due.
Okay. And I plan to respond to my 2 more posts.
Okay. All right.
I had never heard of this until the discussion question. So
Well,
I have all kinds of stuff that I was looking up.
yeah. Well, that's one of the purposes of these is to, other than to fill in some needed time in the course, I like to make them about things that are of contemporary interest, and because I realize that even MBA students don't necessarily follow this stuff on a regular basis. I'm trying to encourage you to follow these things that are obviously of importance. You get some real strong opinions one way or the other about these things, and that's why what I was trying to get at by saying, do you see this as a fairness issue or an economics issue? And one way to look at it, of course, is that it's companies making economic decisions about where they can most cost effectively run their business. On the other hand, none of us like the idea of losing tax revenue and having companies be prepared to relinquish their U.S. Citizenship, so to speak. And so, the ultimate goal here, and I don't know whether we'll fully get to it or not, is to try to say, well, all right, in light of this, how do we fix the problem at its root cause rather than put Band-Aids on it? That's what I'd hope to get to. Anyway, we also have a midterm coming up, the only midterm in the course, and I'm going to have that done next week and posted. It's going to be an online type of test, be multiple choice. And as I indicated before, I had planned to have fairly minimal calculations as part of that test because, I like to make them time-limited tests, and some people are faster at doing calculations than others. So I wanted to minimize the amount of time you would take pushing numbers in the middle of that test. And I had been of the mind that while the homework problems are sort of testing your ability to do the calculations and use the formulas and so forth, and that's still true. But so anyway, I've got the midterm pretty much in hand, on the shelf. I need to get it up on Blackboard, but since it's going to cover through chapter 11, that's a chapter here for our 4th week that we're in. So
yeah, technically starting like today.
Yeah, exactly. Yeah. Now I also wanted to call attention. I don't know whether you recognized it, but I was posting homework solutions on Blackboard after all the submittals were made. I was putting solutions up. There's a folder in the homework. There's a subfolder in the homework folder that is labeled, I think, homework problem solutions or whatever. So I just wanted to make sure everybody was aware I was putting them up there. Now, as I indicated to you earlier, I may be changing the source of homework problems going forward from here. I had viewed the homework problems as an important part of the learning process for this course. That absent the classroom interface that we would normally have in a conventional class, that the homework problems were something that were going to be contributing a great deal to the whole learning process. And of course, for that reason, I made them a significant part of the grade. And I'm beginning to see some what I'll call suspicious patterns coming in on homework submittals that make me believe that there may be solution sets to these homework problems floating around out there that some people have had access to, and that have made for them the homework submittals a say trivial, or it's not what it's intended to be. So in light of that, I think I'm going to have to admit it's going to create more work for me as well, but I think I'm going to have to consider using some other homework problem sources other than those in the text. Now I realized in the text, some of those problems had the prepackaged templates, Excel templates, like that problem 15 that I asked you about, that largely sort of guided you to a solution. And so I still kept some of those as assigned problems. But again, what I see coming in, it pretty clearly looks like it's simply been copied over from a solution set that and not representing any original work on the part of some people. So I may be substituting, even here in week 4, substituting some different homework problems for those at the ends of chapters 10 and 11.
Okay.
So stand by for that. I'll put a notice on Blackboard when I do that, and again, it'll be very quickly the next day or so, because I don't want people. Maybe I'll put a note out to tell people not to start on the problems that had been assigned. I'll be replacing them. Were there any open questions on the homework in general, on your part at least?
Some of this homework is a blur. Let's see. My initial problems were I was forgetting the semi-annual, so it's twice, and so you have to double everything, and so I kept, for different problems, I was leaving, one significant thing out.
Okay. Well, now so you're talking about like bond problems, correct?
Yeah, that's
out of chapter 8.
Yeah.
How are you generally solving the bond problems? Are you using Excel or?
I use a variety of things.
Okay.
If I can try Excel, I didn't figure out number 15.
Yeah.
For whatever reason, I didn't have a problem using that template. And then for some of the other problems, I thought maybe a template might help, like one of those in there. And so I was messing around with that, and that didn't work. Different formula calculators.
Okay.
I try that. I use my financial calculator.
Well, I was going to say, what about just doing it on your calculator?
Well, sometimes I don't know if it's right, but I like with the solutions that you send, it has how to do it with the calculator.
Right.
So that's helpful to know what buttons to push.
Well, the bond problems are very easily done on the calculator. The first big issue is pay careful attention to your sign convention on cash flows. You got to think about a bond price being the cash you're going to lay out to buy the bond now, so it's a negative cash flow. And then you will receive interest payments over the life of the bond, and you'll receive the principal repayment at the end of the life of the bond. So the payment and the future value should carry the same sign. The present value, if that's something you're given, that is the current price, that carries a negative sign. So,
Okay.
so keeping your sign convention straight is the most fundamental challenge, if you will, to solving these things on. Well, even if you do them on Excel, you're going to have the same issue if you use the basic Excel functions like present value and rate and that sort of thing. The other thing with regard to semi-annual interest payments being made twice a year, on the calculator, what I recommend is setting periods per year, that toggle,
To
uh,
two.
2.
Yeah, I
And
did
then,
that.
yeah, so you put that to 2, then you put in all of your interest rates, like your yield to maturity. If you're given a yield to maturity, it should be stated in annual terms, and you can enter it in annual terms, and the calculator will make the
Automatically break it up.
but your end value must be the number of semi-annual periods. So if it's a 10-year bond paying semi-annual interest, N would be 20. The payment would be 1/2 of each year's interest, or the coupon rate divided by 2. Okay. And if you use that approach for the bond problems in the calculator, then if you're solving for an unknown yield to maturity, it'll give you back an annual rate. You won't have to multiply by 2 as some of the, if you leave periods per year at 1 and solve for a yield to maturity, you're going to have to take the number you get from the calculator, multiply by 2 to put it on an annualized basis. So I just think it's much easier to set periods per year to 2, put in your interest rate if you're given it as an annual rate, or if you're calculating the unknown interest rate or yield to maturity, it'll come back to you in an annual form. So anyway, that's now the functions that were like that price function that were contained within that template for problem 15. When I
Right.
saw that on your homework submittal, I thought maybe you found it on the internet. I'd forgotten that it was that it was actually built into that template for problem 15 that you were given or you had available to you. But those there are a variety of those types of very specific functions designed for bond analysis that I normally don't get into in this course. I just stick with the fundamentals on present value, future values, and so forth. But if you're really working with bonds, what's nice about those functions is you don't have to be dealing with whole years or whole half-year periods. As you saw, you can put in a purchase date, or what they call the settlement date, and you can put in the exact date you're buying it, put in the exact date the bond matures, and it does the calculation right down to the appropriate days in the remaining in the bond's life. So that's what's good about those very specific customized bond functions. Okay, anything else in some of these problems?
Um,
I just want to make sure I allow time, if there are any of those kind of questions, to address them.
I don't think that I had any off the top of my head.
Well, your homework submittal was virtually 100% correct. So I wasn't seeing signs that you were struggling necessarily on anything.
Well, there was a lot of, like I would look at something and realize that, wait, I don't think that's right. And then I'd have to like erase everything and go back and recalculate.
Okay. Well, again, I just want to make sure I allow time for those questions. I had posted, my set of notes for tonight's session on Blackboard. I didn't do it till this afternoon though, so I wasn't sure whether you had seen them or not.
I didn't pull them up. I did see that that you did have some things posted.
Yeah.
Wait. You did post something this afternoon? Oh, it didn't show up in my, I guess it didn't show up in my notification.
Um, Should be there. Let me just,
Yeah, no, it's here. It's like, I thought that I would get a note, like a little red
yeah,
number.
yeah, I don't know why that would have happened, or would not have happened, but,
No, I have it here.
yeah, I didn't really finish up these notes until mid-afternoon, so I didn't post them before then. Let me just very quickly comment on some of the key highlights out of these chapters. And of course, chapters 10 and 11 go closely together. Chapter 10 is more of an introductory to the whole topic of risk and return. It's called Lessons from Market History, suggesting that much of it is dedicated to just showing, based on actual market performance, how rates of return have correlated with the amount of risk associated with each class of security. But the key things, most of the details on the tools and the variables that we're going to use for risk analysis are really dealt with in chapter 11. So in chapter 10, the key things are to know how to calculate holding period returns. And what is a holding period return? Of course, holding period returns can be cast in terms of dollar returns or more typically percentage returns. So a holding period is whatever you define it to be. It can be 1 month or a quarter or a year or even multiple years. And so just understanding the basics, especially of calculating holding period returns for stocks, which involve dividend income and capital gains and losses. So there's two components to the holding period return. One being dividends, assuming the stock pays a dividend, and the other being the price change or capital gain or loss. Another important feature in this chapter is the introduction of the difference between arithmetic averages and geometric averages. And I don't know if that's something you've ever run across before or not, but arithmetic average is, what you learn going back to grade school about how to calculate an average of a bunch of numbers. You just sum them up and divide by the number of data points you have. You can do the same thing, of course, with stock returns. You can look at returns over multiple years and add them up, divide by the number of observations, and that'll give you an arithmetic average. But probably the more meaningful average is the so-called geometric average, which is introduced here, and it's a little more complicated to calculate. What geometric averages lead to is something you might have seen referred to as a compound annual growth rate, or CAGR. Sometimes you'll see growth rates quoted, and in parentheses behind them, it'll say CAGR, meaning that it's a geometric average. And the key with regard to stocks or any financial investing is that the arithmetic average is what you would use if you want to assume that history is that the future is going to be like history. It's going to be similar to history. And if you say, well, what do you think the likely return on stocks is going to be over the next year or two, or next average 5 years, you would use the arithmetic average. The geometric average would be used if you wanted to calculate how much wealth will I accumulate over an extended period of time by investing in stocks. And to do that, you have to take into account the fact that stock returns vary a lot from year to year. The higher the variability year to year in the returns, the bigger the difference between the arithmetic average and the geometric average will be. The geometric average will always be smaller than the arithmetic average, as long as there's variability in the year-by-year numbers. So geometric is always smaller than arithmetic, and the difference between them is dependent upon the volatility of those year-to-year returns. So pay close attention to the treatment of that arithmetic versus geometric in this chapter, and try to make sure you understand when either one of those is best used. There is some data, actual market data on the return and risk performance of major asset classes like large cap stocks, small cap stocks, government bonds, corporate bonds, and treasury bills. That's cited and data that's given in this chapter that most people ought to find fairly interesting. And the key point of that is you do see that the markets do, in fact, provide more reward or return for assets that involve more risk. And of course, we're measuring risk here based on the standard deviation of annual returns. So we see pretty clearly, with little exception, that the market has been consistent in rewarding people for risk bearing, and that's the way the markets are supposed to work. In this chapter, we don't really get into much in the detail of calculating standard deviation or its related variable variance, but we'll get into that more in chapter 11. Of course, key thing to recognize is standard deviation is derived from the variance of whatever you're measuring, in this case, returns. And so the standard deviation is simply the square root of the variance. This chapter also addresses real versus nominal returns, and of course, you may be already familiar with the difference there. Real returns are the total returns or nominal returns with inflation subtracted from them. There's two ways to calculate the relationship between real and nominal returns. One is an approximation formula that is called the Fisher model, and for most of our applications, that approximation method will be accurate enough. But the other way is an exact calculation that shows the relationship between real and nominal returns that's covered in this chapter. So key point is just to understand, what do we mean when we say a real return? That's basically saying that's my return after I've accounted for the loss of purchasing power of the dollar that constituted the nominal returns I received. This chapter, at the near the end, also introduces a concept called a risk premium. Risk premium is really fundamental to our work going forward from here. Risk premium measures the reward or return that you got for investing in a risky asset as compared with the return available in the risk-free rate or the risk-free asset, which again we normally assume to be the treasury bill. So the risk premium, and it gives historical data on what the size of the risk premium has been for stocks, large caps and small caps, and as well as bonds. And it's actually, when you're trying to look forward and say, what should I expect the rate of return on investing to be, it's usually better to use the historical risk premiums and then to add to that whatever you believe the risk-free rate is going to be over the period that you're forecasting into. So the concept of risk premium is kind of fundamentally important. Now, moving on to chapter 11, which is titled Risk and Return. This is a much more substantial chapter that is a little more tough sledding here. I really would recommend that you try to, if you haven't already viewed the videos, to view it in at least 2 different sessions. Break it up. It's kind of long, and it's a lot of material to absorb in one sitting. So if you have the opportunity, breaking it up into a couple of sessions, I think, would be worthwhile. The beginning of this chapter, it gets into a discussion of expected returns, and it's important to understand, what do we mean by expected return, and how do we calculate it? And there's 2 fundamentally different ways to calculate expected return. One is based on history, what we would call empirical data, using history as the basis for your forecast going forward. And you do that calculation for an expected return pretty much as you would do the calculation for an arithmetic average. On the other hand, if you're looking forward, as some of the examples in this chapter will do, we'll use scenario analysis, where you define a recessionary economy, a normal economy, and a boom economy, for example. And you assign probabilities to the occurrence of each of those scenarios, and you then have to probability weight your returns for each of the types of assets that you're considering. And there's a rather comprehensive example that's provided in the. Okay, Emma, you joined us. Good. This can you hear us?
Yeah, I can now.
Okay, good.
I made it.
Okay, all right, good. Glad you were able to join. We just started talking about Chapter 11, and again, I had posted notes earlier this afternoon for this. So we just got done talking about expected returns and what they are, how to calculate them, and the difference in the calculation approach using historical data for predicting future expected returns, or using scenarios to forecast future returns. It's real important that even though it may be a little messy and tedious, this slide package walks you through the calculation of variance, standard deviations, covariances, and correlation coefficients. And it's kind of important that you spend the necessary time soaking on those various variables and understand. My main purpose here is not to have you be able to regurgitate formulas or do these calculations off the top of your head. Fundamental importance is to understand what each of these variables conveys to us in the way of information. So variance and standard deviation, for example, relate to a single asset, single stock or single bond. You have their annual returns, you have standard deviation of returns derived from the variance of returns. Covariance and correlation coefficient involve two different securities, and with those variables, you're trying to understand the tendency of the returns of each of those assets to move relative to the other one. So it's a tendency for things to go up at the same time or go down at the same time, or to move in opposition to each other. I did want to make a comment. I was reviewing the video for Chapter 11, and one thing struck me, and it relates to slide 13 in that package. Earlier, and that involved calculation of the correlation coefficient. I had earlier, when we were talking about variances and standard deviations, made the point that you can do the calculation of those either using percentage, either your returns expressed as percents or expressed as decimals. The key point was you can't mix. I'm sorry?
Which slide?
Well, I'm going to be addressing something relative to slide 13, which is the title of which is correlation.
Correlation, okay.
And I'm really referring to something I said in the video that goes along with this PowerPoint, okay? But just backing up, earlier in the video, I'd made the point that you can calculate variance and standard deviations either using the returns data in decimal form or in percentage form. And I said the key point was you just had to have everything on a consistent basis, but that you would get to the right answer either way using decimal or percentages. Then when I got to slide 13, I make the same comment saying that you can again calculate the correlation coefficient with your data expressed either as percentages or decimals. And that is technically true, but I realized that you'd likely have a problem because covariance, the units on covariance is percent squared. It's the percent squared is the units on covariance. So you couldn't, for example, if you look at the correlation coefficient or the correlation slide 13, the numbers for the correlation there, the covariance is shown as minus 0.0117. You see that?
My printout, I have to pull it up. My printout, it's blank. That whole section.
All right. My point is to convert the 0.0117 covariance to percentage, you don't multiply by 100 as you normally would. You actually have to multiply by 10,000. So you can do the calculations either as percentages or decimals, but in this case in particular, involving the correlation, I strongly recommend you would do any of your calculations in decimal form rather than trying to convert a covariance number that you got from somewhere to its decimal equivalent, or from its decimal equivalent to its percentage equivalent. So I just, in reviewing that video, I said, ooh, that's going to be an issue because you can't do the normal kind of translation between decimals and percents that you might normally think of. And so I wanted to point that out to you anyway. It's not that you're going to be doing a lot of covariance or correlation, coefficient calculations, but I didn't want to have that pitfall sort of hanging out there for you. In this chapter, we may have been introduced before, but there's a heavy treatment on the difference between systematic and non-systematic risk, and this is a very important fundamental concept. Segmentation of risk into at least these two categories that depend upon where the source of the risk lies. And you can think about systematic risk being risk related to macro type factors, the overall economy, politics, geopolitical things, whereas non-systematic risk is risk that derives from issues related to a single company or to a single industry, typically. And that differentiation is very important when it comes to understanding how diversification works. Now, without taking this course, you have some sense of what diversification is all about. It's about not putting all your eggs in one basket. It's about hopefully having some things that will do well while some other things might be doing poorly in your portfolio. That kind of balancing is what we normally think of as diversification. But in order to really understand how diversification works, it's important to understand the difference between systematic and non-systematic risk. So I call your attention to that part of the discussion. Then we get into the term efficiency or efficiency in investing. And a number of slides here are dedicated to trying to convey some basic understanding of the foundations of what's called modern portfolio theory. We still call it modern portfolio theory, even though it's getting a little old now. Its origins go back to the 1950s and 60s, but the foundations are still the same as they were developed way back then. And the idea of efficiency in investing is simply to try to get the highest return available for a given level of risk. As individual investors, we have different risk tolerance. We have different ability or willingness to bear risk. And the market provides you opportunities to accommodate those differences in your risk preferences. You can invest at the low end of the risk spectrum, or you can be aggressive and invest for higher returns, which would mean going out further on the risk spectrum. The key, though, is wherever you choose to set your risk tolerance, you want to try to get the highest possible return at that level of risk. And that's what's involved in this concept called the efficient frontier, and there's something called the capital market line. And this capital market line basically leads you to conclude that if everybody had the same view of outlook for the future, then everybody would hold just one risky asset. It would be like an index fund. And of course, index funds are very, very popular, have been for quite a while now. Index funds, the idea being you just buy one asset, like one mutual fund or one ETF, and you get a microcosm of the total market. The thinking behind index funds came out of this modern portfolio theory and the recognition that if everybody had the same view of the future, there's really only one relevant risky asset, and that would be something like a super index fund that was made up of all stocks. Now we have index funds. We don't really have an ideal index fund, but you can get very close to it through the use of ETFs and mutual funds that are designed specifically to be models of the total market. Later on, we get into discussion of a variable called beta. And beta is a measure of how much of that systematic risk sensitivity an individual asset carries. How much of that macro risk exposure or sensitivity does a stock carry, for example? So the market, everything is measured relative to the market. The market, by definition, has a beta of 1. And so when you calculate betas, and this chapter and this slide package walks you through where the beta calculation comes from. But once you calculate beta, you have a handle on the relative sensitivity of an individual stock to events that affect the whole market. And that's important because those events are events that you really can't diversify away. You can't shelter yourself from exposure to those kind of macro risk elements. And you therefore, the best you can do is adjust your portfolio to have a beta, again, that's consistent with your risk tolerance. Then the chapter moves along to discuss the capital asset pricing model. And the capital asset pricing model is one of the most fundamental tools of financial market analysis. And it's also relevant to corporate finance in terms of it's pointing you toward what your cost of common stock equity capital is. And in corporate finance, your primary focus on the markets is to understand how the markets are setting your cost of capital. What is the money that you need to run and to grow your business? What is it going to cost you? And that cost is expressed as minimum acceptable return per year on that capital. That's what the market's looking for. Can you meet or exceed a minimum expectation that the market sets for your business based on the riskiness of your business overall? That becomes part of your cost of capital, or what we call a hurdle rate in corporate finance. So again, you should become very familiar with the form of capital asset pricing model as well as what the message of it is. It should, as I say here in the notes, it should almost become second nature. It's a very simple relationship. It says that the return that you should expect on an individual stock depends fundamentally on 3 things. The general level of interest rates as reflected by the risk-free rate. Secondly, by the market risk premium. We talked about the risk premium a bit earlier. So the question of how much of a risk premium is the market paying for 1 beta's worth, that is a beta equal to 1, of risk bearing. And the third thing is the amount of specific systematic risk that each stock contains or presents to an investor. So 3 factors: general level of interest rates, risk-free rate, market risk premium, and that's defined as the return on the market minus the risk-free rate. And third is the individual securities beta. Exactly how risky is it relative to the overall market? The discussion of the CAPM then leads into another graphical representation called the security market line, or SML. And one thing I'd point out to you very quickly, because it's easily overlooked, earlier we had something called the capital market line. The capital market line applied to the relationship of return versus risk for diversified portfolios. The horizontal axis on the capital market line is the standard deviation of that diversified portfolio, the sigma. When we're talking about an individual security, however, and we're looking to the security market line, what you see is the horizontal axis risk measure is beta, because beta is what's relevant in the way of risk, or the risk parameter for an individual security. With the CML, we're talking about diversified portfolios. Their diversified portfolio really only contains systematic risk. You've diversified away all the non-systematic risk. And thus, the horizontal axis for the CML is sigma, standard deviation. For SML, it's beta. So I just want to highlight that to you as you look at them. Pay careful attention to the fact that those two seemingly similar looking graphs have different measures of risk that are used as their independent variable. That is the horizontal axis variable.
Is that slide 43 or what?
Which slide? You mean which slide I'm talking about?
Yeah.
Okay. Let me see. Let me grab it here. Well, if you look at slide 32, there's a representation of the capital market line.
Okay.
And you see on the horizontal axis, the variable is sigma, or standard deviation.
Yeah.
If you go to, let's say, slide 41 or 42, these are security market lines that represent the capital asset pricing model conditions at a given point in time.
And
And
that's
the horizontal axis variable is beta.
okay.
And the reason those differ is that beta is the appropriate risk measure for an individual security. Whereas when it comes to a diversified portfolio, you can use sigma because the portfolio's sigma is all systematic risk, because by definition, this is a highly diversified portfolio we're talking about when we discuss the CML. It's important that you understand what beta is measuring, why it is that we use that particular form of risk measure for an individual asset. And again, it has to do with how much risk an individual stock brings into a diversified portfolio. That relevant risk measure is beta. This video discusses, the origins of beta. It comes out of regression analysis. If you've had quantitative methods courses of any kind, you might have studied regression analysis, and you know that if you do linear regression, you're trying to find the slope of the so-called characteristic line that helps you determine whether there's a relationship between the independent variable and the independent variable and the dependent variable. In this case, relationship between the market return and the return on the individual stock. So, hopefully if you have any questions on beta, and because it's a very important concept, and by the way, this is not something that's just some academic abstraction. You listen to CNBC or other business investing type of TV channels, you'll hear them referencing beta quite frequently, and so it's a very commonly employed frame of reference for real world investing. Finally, the last point I'm making here is a discussion of the security market line and what determines the location of the security market line. Obviously, it's set first by the level of the risk-free rate. That establishes the vertical axis intercept. And then the slope of the security market line is really a reflection of how risk-averse the market is at a given point in time. In other words, when investors become very concerned about prospects for the economy or where the market's going overall, or when geopolitical events erupt and cause people to get nervous, the security market line steepens. The risk aversion increases. And when that happens, what's fundamentally happening is that the required return on risky assets goes up. And the more risk the asset embodies, the greater the increase in the required return will be. And the last point I'm making here is it's important that you understand when market conditions change such that the required return goes up for risky assets, what happens to their price? What would you think logically or intuitively would happen to the price of assets when the market says we want greater reward to bear that amount of risk? Would the price go up or down?
Greater reward, it would go up.
What did you say again?
If if it was a greater reward, it would go up.
Well, that's not right. That's incorrect, and that's why I wanted to emphasize this point. The way to think about it is this: what the market's doing when it prices a share of stock is it's basically pricing the claim on the future earnings of the company. Correct? That's what the price of a security is. It's the value of a proportionate ownership of the claim against future earnings. When the market becomes more risk averse and requires a higher rate of return, it really can't change the earnings outlook for the firm. What it can do is lower the price. So the way the market gets a higher return is to drop the price and make that investment opportunity available to you at a lower price. So if you can buy the same future earnings at a lower price, then your return is going to be higher. So the main message here is, and this is sort of a key mindset that is difficult for students just learning about finance to make, is that there's an inverse relationship between the required return that the market sets for an individual asset and its price. When the market wants a higher return, it's going to cut the price. When the market's willing to accept a lower return, it'll raise the price. And when you think about major excursions of the market, when things that have happened that have caused risk aversion to go up in the market, think about 9/11 back 13 years ago. 9/11 caused the stock market to drop by probably, let's see, it went down to 6,500 if I remember correctly, and it was up above 10,000 on the Dow. So it was, call it a 40% plus or minus drop. And most of that was not because the earnings outlook for companies had deteriorated badly, at least not in the short run, but rather because people were anxious about where the country, the globe, the global environment was going. And they pulled in their horns, so to speak, with regard to risk bearing. And so that collapse of the market price, as reflected in the Dow, was largely a result of people saying they wanted to be rewarded with a higher return in order to bear risk in that environment. So another, again, key fundamental concept that it's important for you to understand is required returns and the price of financial assets are inversely related to each other. When one goes up, the other goes down, and vice versa. Okay? So look again at the CML, which reflects the conditions for the capital asset pricing model. Understand what is it that determines the position of security market line on that set of axes. And think about what happens when certain changes occur, like increased risk aversion or decreased risk aversion. The line becomes either more steep or less steep. If interest rates go up, maybe because inflation expectations go up, you can think about the risk-free rate rising or falling, and that would tend to shift the security market line parallel to its prior position, either up or down. So again, higher interest rates translate to higher required returns and therefore lower prices. So some of those key mental frameworks are kind of important that you take away from these chapters. Now, again, Emma, I think just before you cut in or joined us, I recommended for Chapter 11 that if at all possible, try to break your viewing of the video up into at least two 2 sessions so that you don't have to try to absorb all of that stuff in one sitting. I don't know, maybe you do that most of the time anyway. I know you spend 10 minutes, you say, I'm tired of listening to this guy drone on, and you push the button and silence me for a while. That's understandable, but you obviously should try to listen to material for a long enough period of time that you get some sense of continuity. But in this particular case, as well as others where we have lengthy videos, it's a pretty good idea to break them up into a couple of sittings or sessions to get through all the material. And again, another key thing I mentioned earlier, within the next day or two, I may make some changes in the source of the homework problems that we're going to be doing going forward. I may not be using problems out of the end of the chapters in the textbook. I think I mentioned this to you in our phone conversation a few hours ago.
Yep.
So just be aware if you see an announcement on Blackboard relating to that. What I'll be doing if I make that change, and it's probably pretty likely I will, is that I'll be posting actual posting problems in a file on Blackboard and using those rather than the problems out of the back of the chapters to as our homework problems going forward, beginning here with week 4. So for the time being, the next day or so at least, if you were inclined to, maybe you want to hold off getting started on those homework problems. Did you have you had a chance to work on phase 1 of the case?
No, I'm doing that as soon as we get off the.
Okay. All right. Well, again, for me, it was just a case I wanted to make sure you're on the right track in the initial part of that case.
Okay.
And I said, well, if you can get it to me by today, I'll get it back to you by I think I said Sunday or something. I'd actually try to turn around within a day of whenever you submit it. But just make sure. I just want to make sure you're aware that you should get that phase 1 to me so that I can give you any guidance necessary or tell you you're on the right track and go ahead into phase 2, because we want to have that wrapped up by about a week from now.
Is it like this corporate inversion? I think I'm the only man out on the consensus of corporate inversion, which is it's a good discussion.
Well, we spent a few minutes talking about that earlier, and again, there's multiple purposes to these discussion forums, and and the selection of this topic in particular, because it is a topic that's of contemporary interest politically as well as in the finance world, and the issue of nobody likes the idea that corporations might not be willing to pay their fair share. The problem is, what is the fair share? It's a fair share depends on whose seat you're sitting in.
Yeah.
And the real crux of the problem is, how do we fix the root cause of these things? And by the way, I made a couple of postings this afternoon, additional postings of my own, and so try to make sure you take a look at those if you can. And how do we fix it at its root cause, as opposed to putting Band-Aids on and trying to push people in the corner and say, no, you can't go there.
Yeah.
Rather, what we'd like to do is say, let's make it such that doing business in the United States is a no-brainer. Everybody should prefer to do that. That's the kind of condition we'd like to get to, so that they're not tempted by these low rates. The other problem is, the other side of the coin, and I think you alluded to it maybe in one of your recent posts, is, we can lower the tax rates. The problem is, you hear people talk about a so-called race to the bottom. If it gets into a bidding war where every country is trying to lower their tax rate to be lower than the next guy, then the next thing every country has given up a bunch of tax revenue, and everybody loses. You want to avoid that as well. So
I think you can also look at it as, even if the taxes are lowered, should that ever happen, they're still going to look for loopholes. It still won't be enough.
Well, and in one of the posts I made this afternoon, I note the fact that, you know, if we could eliminate a lot of the loopholes, and one of my pet peeve loopholes is the Energy Star credit. You know, when Maytag or General Electric make an appliance that meets certain energy efficiency standards, they get a tax credit. And if you buy that appliance, you as a consumer might get a tax credit, at least you have in recent years. So I'm saying to myself, if an efficient appliance is an economic thing to own, why do we have to have the government subsidizing the manufacture and the purchase of them so as to seemingly create a market for them? Why not let people sell appliances that are more efficient because that's what consumers want? And what happens in those cases, like Maytag, I'm not sure, I haven't checked recently, but Maytag for years paid no corporate income tax solely based on all the credits they had accumulated under the Energy Star efficiency program. Now, yeah, it is great. Get rid of that stuff.
Yeah.
You know, make Maytag and General Electric start to pay respectable tax bills. Then you can lower the 35% rate. And by the way, when you add in state taxes, most corporations pay about 37 to 38% effective tax rates.
Yeah.
You can lower that rate and yet not lose any tax revenue because you broaden the base. You're making everybody pay rather than giving these special breaks to certain select parts of industry solely based on their lobbying efforts.
Yeah. Well, that's why I'm kind of against the inversions. I mean, for me personally, I think corporations find any way possible to dodge some tax, or, you know, would I like that on? I hate seeing how much money I pay in taxes out of my paycheck every time I get paid, but I can't find a loophole around that, you know? And for my property taxes, they always go up, but I don't have loopholes around that. And we have these corporations always find a loophole to avoid paying large amounts of money, which probably is why we have a 35% rate, because we keep going up to make up for all the loopholes we allow corporations to have.
Well, and you know, I think most people most people would probably say, yeah, we should eliminate many of these loopholes, if not all of them. And the problem is that one by one, the lobbying of different entities, and it isn't just corporations. You know, there's lobbying that goes on by all kinds of vested interests in our system. And so, you know, if we can get rid of those special treatments, then we can lower the top rate, because there are corporations who face those very high rates.
Yeah.
Who, you know, there's the Maytags who don't pay any rate, they, you know, don't pay any taxes, and their rates of no importance to them. But then there's the company that has to pay a full 35 and maybe 38% tax rate, and for them, it's a big disadvantage when they're competing against Irish companies. Are you in the pharmaceutical business yet, Emma?
No.
Oh, okay. Well, you know, Ireland attracted a lot of pharmaceutical industry companies with their 12.5% income tax.
Yeah,
You know,
sure.
so they.
Is that the Pfizer deal?
Huh?
Was that the Pfizer deal?
You talk about the Pfizer inversion?
Yeah.
Well,
to Ireland? Was that, or was that Medtronic and?
there were, you know, the Pfizer deal didn't go through, and that was with a UK company, not an Irish company. But that deal didn't go through because the English company they were trying to link up with to structure one of these inversions wasn't interested. And so, but another point I made in one of my posts is, you know, it's kind of interesting. You look at it sort of from a macro perspective. This big differential in tax rates of U.S. companies, especially those just operating in the U.S., against foreign companies, it ends up um, creating a situation where a U.S. company is much more valuable to a foreign company who might acquire them than they are as a standalone U.S. company, simply because of the difference in the tax rates.
Yeah. I
Think
read
about
that.
the after-tax cash flows. If you're paying a 35% tax rate versus paying a 12.5% tax rate, that translates directly into bottom line value of the company. So what it means is a foreign company can afford to pay more for an American company if they want to buy them out. And so we actually create an incentive for foreign companies to take over American firms simply based on differences in tax rates. And that's sort of like the mirror image of this inversion problem. In the inversion situation, it's American companies seeking to, get out from under that rate. In the case of foreign acquirers, it's a matter of taking an American asset, an American company, and pulling it into your tax environment and making and creating value because you can buy it at an attractive price relative to what the company sells for in America. So, there's no simple answer, and unfortunately, the answer for the root cause of inversions requires a true comprehensive tax reform package, and that requires Washington to sit down and agree to do something that's big time complicated and potentially is going to cut a bunch of people out of their special privileges that they've enjoyed over many years. So it's going to be exceedingly difficult to pull off. It's going to take, not only cooperation, it's going to take people with a lot of fortitude. If you're a politician, you say, do I really want to take this bear on? But we need them to take it on because, what we have right now is a situation where we're really deteriorating the competitiveness of American companies, and they will do what they have to do to deal with that. And one of those things they do are these inversions. So, you can't really talk about fixing the inversion problem without talking about comprehensive tax reform. And, back to your comments, Emma, we do have some loophole. I don't know, are you a homeowner?
Yeah.
You get to deduct your mortgage interest or expense, right?
Yeah, I guess, but I
If
don't.
you
I don't see it helping me in the end. I guess it is.
but if you itemize your deductions,
Yeah.
if you own a home and you probably itemize your deductions, you get to deduct the interest expense associated with your mortgage. Why?
Yeah. Well, I guess it's the same with student loans as well. So.
Yeah, but student loans, by and large, the interest on those are not tax deductible, or at least they're not. If your income is at a certain level and above, you can't deduct those. I've been out of the student loan business for quite a while now, so I don't pay much attention to it. But
yeah, they send you. I haven't looked too into it, but they send during tax season. I get a W-2 and I put it with the rest of my stuff when I file my taxes. So I think there's some that you can, but yeah.
Well, again, as a homeowner, you also get to deduct your real estate taxes.
Yeah.
So you get some tax breaks too. There are some people who talked about as part of comprehensive tax reform. There's some people who would take away or severely limit the mortgage interest deduction.
Yeah.
Now, again, somebody's got to have some real fortitude to take on that one because that will make everybody mad, or at least all homeowners mad. So you can get a sense of how difficult it is to do these kinds of reforms. But it's really what would be required to permanently and completely fix this inversion issue or phenomenon that we've discussed here. So anyway, okay. Anything else that needs to be addressed right now?
Is there another person in this class?
Well, there's one who has not joined us in any of them, and he basically said, this is why I took an online course, because I can't dedicate specific time during the week to these kind of sessions. And I my point, my position with him was, well, these are voluntary. These are intended to be, something that will help, are available to help you to the extent they can. But certainly, since this is an asynchronous course, or is intended to be, I couldn't make participation in these totally mandatory. So yeah, there's one person who has not, and I don't expect will now participate in these. But yeah, well, I'm glad all four of you hung in anyway. It would have been getting really lonely if we had lost anyone.
I'm glad that they let it continue.
Yeah.
Yeah. Well, that was a touch and go situation at the very end there, as we lost enrollment a few days before the class started. So yeah, Jen Reimert was very instrumental in keeping the course intact. So you can sort of give credit to her. All right. Well, if that's it, I'm going to wrap up this recording session, and I'll see if I can get this thing loaded up again. And at least I remembered to record it this time. So, all right. Well, stay tuned. Pay attention to the case, and if you have any further thoughts on the discussion topic, take a look at the post I made this afternoon, and get your final inputs in by tomorrow. And that's
the case is. I have to get my Blackboard up. The case is technically, the first part is due tomorrow, or is it due tonight?
Well, I had said tonight, but simply because I just wanted to be able to turn that around to you quickly and get it back. But I'm not going to have a problem if it's not in until tomorrow or Saturday.
Okay. I thought it was tomorrow. Okay, I'll try and get it in tonight, though.
Well, yeah, okay, whatever.
I just have a few more adjustments to make.
I just put those dates in there to sort of give us targets that would allow us to, in an orderly fashion, get to the end with that case. So.
Okay.
All right.
I'm just sad I don't have an umbrella behind me today.
Well, you should be. That was quite an accomplishment to be able to even participate part-time last week.
Yeah, I tried. It just kept going.
So that
the
was,
Wi-Fi there isn't the best. So
I was going to say, was that a hotel Wi-Fi you were able to tie into?
yeah, and it only really works best in some areas depending on the hour. So
Yeah.
and they even charge you for it, which is ridiculous. But that's why my post was so crazy, and I'm so sorry because I thought I fixed it before, but
Not a problem. Not a problem at all. Again, I was impressed that you made the effort to get connected from a beach in Mexico.
Yeah, we were all kind of jealous.
Yeah, we were sort of saying it's probably just a picture of her sitting there in front of an umbrella, that she's not really participating.
yeah. Well, I thought you guys were gonna think I was drunk when I was writing when I wrote my post. Just
No,
I was doing it on my iPhone, and
No.
the autocorrect on the iPhone is just insane. And sorry.
No, well, I just again, it wasn't a problem. I just said take a look at it again when you're back in the States and correct a few things where it was clear you'd had some typos or said things you probably didn't intend to say. But,
Yeah.
all right, no problem.
All right. Thank
All right,
you.
guys.
Have a
Talk
good
to you
night.
next week. And
Thanks.
as always, contact me if you have any questions.
Okay, thanks.
Okay.
All right.
Bye.
Good night.
Good night.